Hello, good afternoon. I hope we are all well. All right, so Nehemiah here again, and this will be my first recording on investment fundamentals. Sorry, I'm having some sore throat, so my voice is not really coming out like that, but I'm sure it will be okay. Yeah. All right, so if this is your first time on this channel, kindly subscribe to my channel and also like this video so that YouTube can promote it to others who might need this video. All right. So we will be talking about everything concerning the week one in the course outline. Um so the course outline for week one covers what an investment is, reasons for investing, components of the required return, real interest rates, real assets, and a real asset versus financial assets, direct versus indirect investment, basic investment philosophies, and then you end at ethics in investment. So that's what we are going to cover up in this session. And it's it's quite bulky. So we are going to do this very, very, very fast. All right. So this is basically some updates which we normally do in class before we begin each class session. So during my class, the lecture will let us go and then watch some Bloomberg briefing. Then we'll create a PowerPoint and then come and present it in class each and every morning or each and every time before the real class session starts. All right, so both time and both time. All right, so what's an investment? So an investment is the current commitment of resources for a period of time in the expectation of receiving future resources that will compensate the investor for the time the resources are committed, the expected rate of inflation, and the uncertainty for future payments. So basically, you are committing resources, maybe money, so that you be compensated for the time that you've saved the money or committed the money into that particular work or investment, and also to be compensated based on the expected inflation rates and also the uncertainty of future payments, which is maybe the future payments might not come or it might come. That's the risk, right? Okay. So are the following investments money kept under pillow? Is it an investment? No. The reason is because there will not be what? Any profit or any compensation or any uncertainty for future payments. So since there is no um uh, reasons attached, like money kept under pillow will not have resource has been committed placed under the pillow, but there is no you will not be compensated for inflation, right? And then since it's under your pillow, unless maybe someone comes into your room and then steal it, aside that, you will get your money back. And is gambling an investment? Gambling in finance is not an investment. Then money spent on private car or brand new laptop, and also investment in a commercial vehicle, right? So um, they cannot be in a form of investment. For example, investment in commercial vehicle can be in a form of investment. This is because you are expecting to what? You're expecting the commercial vehicle to come and then work for you, and then you get what? Profit. So in total, you're expecting some return, right, on your resource committed. All right. So reasons for investing, we invest for income, also invest for capital preservation and also capital appreciation. When we say income, what we mean is that we want to gain what? Profit on our investment, and also for capital preservation, which means that if we won't get anything, we are going to what? Maintain our capital at the end of the period. And also for capital appreciation, which basically means that we are going to what? Get some kind of income or like our capital being, let's say, if we invest 10 cedi, at the end of the period, we're expecting to what? An appreciation to, let's say, 11 cedis or the likes. All right. So components of the required rate of return. So in order to defer consumption, investment needs compensation for three resources. So you see, the reason why we are investing is because if not that we are investing, we would have equally what spend that money on something. But in order to defer that consumption, the money, the thing that you're going to spend money on, we need to be compensated on the pure or real interest rates. And then for the inflation protection, and then for the risk, right? So real risk-free interest rate. So the real risk-free rate of interest is the exchange rate between the future consumption and the present consumption. This rate of interest can be thought of as the pure rental rate on money in the absence of inflation and risk. Why is the risk, why is the real risk-free rate usually positive? Borrowers are willing to pay to be able to spend more than their current resources allow. Savers need compensation in order to give up the right to consume today. So this is basically some brief explanations, and they look self-explanatory, so I don't need to complete. So the Fisher's equation. So the Fisher's equation is all about the nominal interest rate, the real interest rate, and the expected inflation rate. So the I here is the nominal interest rate. The R here is the real interest rate. And then the pi here is the expected inflation rate. So this formula can be written down to this when you simplify it. So when you simplify this, you are going to get this. I don't want to waste time on that. So you can just keep either this or this. And keeping this, right? I here being the nominal interest rate, R being the real interest rate, and then the pi being expected interest rate. This is what we are going to use in like, I think 10 slides from now. We are going to explain things around this. So, yes, it's the the R is the real interest rate, compensate investors for delaying consumption. And then the pi is the expected inflation rate, which compensates investors for loss of purchasing power. Note that the Fisher's equation contains no premium for risk, such as default risk. So we can think of I as being, which is the nominal interest rate, as being what? A risk-free rate. So this is just about negative interest rates. So can interest rate be negative? Ex post real interest rate. So can previous, in like looking back, what real rate of interest did you make on your money? So ex post talks about the rate you invested in, like invested. So if let's say at the time of investment, if let's say at the time of investment, right, interest rate was 10%, right? And then now that you are recouping, so let's say you invested 10 years ago, and then interest rate was what? At 10%. And now that you are recouping interest rate, so 10 years now, and now, interest rate is around 12%. You can see that when you subtract 12 from 10, which is 10 minus 12, you are getting negative 2%, which means what? Interest rates or exposed real interest rates can be negative, right? So if you invested 10 years ago at 10%, and now that you're about to recoup your investment, the interest rate is 12%, then it means what? Interest rate is negative, and you are what? Making some loss in terms of interest rate. And X and so X and through interest rates. Can that one also be negative, which is future interest rate? Can that one also be negative? What this means is that if let's say you are also investing now at 12%, and then in future, let's say inflation goes to let's say 14%, or interest rate is now 14%, right? It's what possible that what you are what making a loss. So this will all boil down to this. This will all boil down to I, which is the nominal interest rate, is equal to R plus the power, the pi, right? So if let's say the nominal interest rate is 4, and then the real interest rate, we don't know. Let's put R there. And then our pi, which is the expected inflation, is like, let's say, 6, right? Then for when the 6 cross here to become -6 is equal to R. So it is what? -2 is equal to R. Then it means what? Real interest rates can be negative, right? So if expected inflation increases more than the nominal rate, then there is what? An expectation of what? Interest rate being negative. But if it is less, then expected rate will be what? Positive. That's basically it. So what about nominal interest rate? Yes, nominal interest rate can also be what? Negative, right? The reason is because nominal interest rate, which is the I, is equal to the real rate plus the pi. So in a situation where R is, let's say, 3, and then expected inflation is rather deflating at a rate of, let's say, -4, then we are going to get I to be equal to -1, right? So this equation is what I said we'll be working on. So anyhow, since it is an equation, I can be negative any point in time and I can be positive, which is I being the nominal interest, it can be negative or positive. So look at an example here. I suppose real rates can be negative, right? An example is in 1965, your grandmother put a large quantity of money in a 10-year term deposit with a fixed rate of 4%, right? Let's assume that the real rate was 2%. So expected inflation was 2%. So way back, because so let's bring this down into here. So they are saying that the expected the nominal the fixed rate is 4, right? And it's equal to the real rate being 2, and then the expected inflation also being 2, right? It was a 10-year something. So in 1975, which is the 10 years, inflation is 12%, and the rate of inflation is 12%, and the rate of inflation has averaged 6% during the 10-year period. So now, inflation, this one, or this one has changed to 6, right? So since this one has changed to 6, we don't know the real interest rate. Let's represent it by, let's say, X. Okay, now let me use the R. So R, right? So now if we want to look for R, when you bring 6 to the other side, you will see that R is equal to -2. That's the same thing here. So can X ante the X ante was the ante was the then can X ante real rate be negative? Yes, that one can also be negative. So look at it here. In May 2011, the annual rate of inflation peaked at 3.9%. Let's assume that the official rate was 0.25, right? So the nominal is this 0.25. And then we don't know the real rate. Inflation was at 3.95. So we remove this here, right? It will now be what? Negative. When we move this here and we subtract, it will not be negative 3.65. Right? So that one can also be negative, as I explained. Then can nominal rates be negative? That one is also yes. In the past few years, we have had an unprecedented situation where some nominal interest rates are negative. Concerns about very weak world growth and inflation. So what is deflation? So we know inflation is a persistent increase in the general price level of goods and services. So deflation is also what the reduction. So deflation is nasty for many reasons, but here are the two main ones. Because of deflation, consumers postpone consumption, economic repercussion of this. The real value of debt rises, right? So look at this. You have just bought a house for $500,000 and you have a 10-year interest only a mortgage for the full amount. You are an investor and you intend to hold the house for 10 years. You are investing in the house, right? You are investing in it. So now let's assume the value of your house increases or decreases at the rate of inflation and deflation. What is it worth in 10 years' time? Right? Look at it. You are an investor and you intend to what? Buy, like maybe sell the house after the 10 years. So there is the value of the house. So if in case of inflation, right, then it means that at the end of the 10 years, you being an investor, this will be the value of the house. So meaning when you sell it, you are going to make a profit because you bought it at 500,000. And then when you sell it within this, you are going to get, I think, 171, right? You are going to get 171. But 171,958, that will be your profit. But if in case things are being reduced, if there is deflation in the next 10 years, right, then you are going to get 368,712, which is lower than the initial amount you purchased um the uh, the mortgage, right, or the house. So basically, this means that you are going to make some loss of 500,000 minus this, right? So that's what they are trying to say, that deflation will really hurt investors because when you buy something now, later on you are going to make a loss, as it's here. All right. So negative real interest rates and pension funds. So basically, what this side will be talking about is pension funds and how interest rate is going to affect them in the near future. So in the 2019 fiscal year, state has had 1 point. So this is basically some Bloomberg briefing, right? So state has had 1.48 trillion in unfunded pension liability, while the 50 largest local government pays 478 billion in adjusted net pension liability. So this is just the Bloomberg briefing, some of them. So I think this is not really, let me just skip it. So combining the real rates and expected inflation. The nominal risk-free rate of interest adjusts the real risk-free rate to reflect expected inflation over the life of the investment, taken into account. All right, so taking into account these two factors, time and expected inflation compensates invested for time value of their money. So expected return. So in business finance too, we learned about expected return, which was 1 plus the nominal risk-free interest rate times 1 plus the risk premium minus 1. Right. So we will talk more about it later in this session. So here we are come to talk about taxes and like when we take taxes and expenses into account. So it's what you get to keep. So let's look at something here. An example, the return on a tax deferred account average 8% over 20 years. The initial investment is $10,000. The tax rate is given as 25%. Compare the investor's after tax value of his portfolio if he withdraws all savings at once after the 20 years. The value of an equivalent portfolio earns 8% pre-tax. So basically what it means is that after the 20 years, when you invest, right, you are going to get 8%. Your like it is annually. So you're going to get 8% annually compounded because you're investing for 20 years. And then at the end, if you try to withdraw or you are going to attract, it's going to attract a tax rate of 25%. So at the end of the 20 years, 10,000 invested in a tax paid account would have grown to, is it using the time value of this thing. So the future value of the 10,000 at the rate of 8% for 20 years is going to give us this, right? So after tax, taking tax out, you can find 25% of this, and then you subtract it. It's the same as 1 minus 25% multiplying by this, right? And then you're going to get this. This is what you are going to be left with when tax is being deducted from. So at the end of 20 years, 10,000 invested in taxable accounts would have grown to the rate is now, if you are being taxing or taxing the rate, right? So you are being compensated 8% annually, right? So if um, if it will grow right? Your 8% when we take tax out will not change to 6, right? That is only 1 year. But if it is being compounded, so when you bring the compounding distance raised to the power 20, we are going to get more than 0.06. Maybe it will be 0.066, something like that, right? Which will make maybe the amount looks almost equal to this. But here, because this 8% is going to be 8% up to 20 years. So if we are to raise the power by 20 here, it is going to change here. But here, it was being what? Tax was being deducted before they brought it down here. So 20%, 20 years is now being brought here after tax has been deducted. So here they factored in that tax is only for the first year, so I don't know, right? That's why they had this amount. But if you are going to factor in the tax here, the years here, right? Then this 0.6% is going to change because of what? The compounding interest, right? So taxes affect investment decision. Some investments allow for lower or no tax burden. So capital gains on stock, for example, has no tax burden. Dividend paid by listed companies attracts 8%, which will be learning in taxation. Dividend interest and any income from a unit trust, mutual fund also earn low or no tax burden. And then interest from a resident financial institution, and also interest on government bonds. So some allow for deferred tax liability, which is like tax that you are going to pay in the future. So recent trends in investment. So hedging US election uncertainty. So basically, you see the US dollar, for example, is normally considered as a reservoir also. Most countries have reservation in the US dollar. So when election is approaching, where there's an uncertainty that there might be fights or whatsoever, people tend to want to shift their investment into a safe haven, right? So yen is considered as a safe haven and also like gold. So when we say safe haven is an asset that when investing, it's either it will appreciate or your investment will remain the same in the case of economic uncertainty, right? So the yen, a safe haven currency, is undervalued and has room to appreciate as global interest remain low and investments move away from the US dollar, as this man said, Goldman Sachs. So we think that the Japanese yen probably will continue to be there. So basically, in this course, it's more of Bloomberg briefing, right? So you really want to understand me being a forex trader, for example, this course is a plus for me because it will let me understand some fundamentals of my trading techniques, right? So basically, so makes sense to short US dollar and buy yen before election. And after that, if everything is okay, then you buy them. So, however, after large fiscal stimulus likely to lead to depreciation of the US dollar in favor tourist currencies such as the Australian dollar and Canadian dollar. So yen pressured as vaccine hopes boost. So the yen scrapped back some losses. That was way back during the COVID-19. Right, the dollar on Tuesday after the safe haven currency took a dropping on news of the development of coronavirus in which ways optimism of the global economy from role of gold in investment. So gold provides safety, especially when markets are in turmoil. Assets that pay off perform well when market has low or negative returns. So basically, whenever interest rate is being increased, right, then gold tends to underperform small because people will now be what investing more because of interest rate. But if interest rate is being reduced, people tend to shift their investment into gold. So when interest rate is being reduced, gold rises. And then when interest rate is being increased, gold falls slightly. Such assets are attractive because they stabilize the portfolio and the expected return on such assets can be low or negative. And this investor do not need much compensation to hold this asset. So why gold may be beneficial after the US? So that is because the United States will likely adopt a sizable fiscal stimulus program no matter which candidate wins the presidency. We would be printing trillions of dollars more and all of the ultimately has extraordinary positive implication for gold. So we can just this year is basically an election year. Let's look at when the US election happened. It was November something, November 5th or so. But that was 5th November. Let's look at something. So on 5th November, I'm coming to Trading View to check on something. Let's check gold on 5th November, before 5th November. So So 5th November is so before 5th November, gold was already falling, right? Because of the anticipation of the US election. Then after US election, when Donald Trump won to, gold price fell up to $2,536 per ounce, right? And now after the election, we can see that there is some kind of rising. So it rose to 2,716, and then it came back, and it is highly possible to continue the run upside. So you can see that after the election, it is going to move back up. That's what it means. So fiscal stimulus or policies such as government spending or tax reduction aim at boosting economic activities typically leads to a wider deficit. That could, okay, that could undermine investors' confidence and prompt them to put their money to safe haven assets such as gold, and in turn push gold price higher. So what happened to tech stocks when a vaccine was announced? So you see, during the COVID-19, right, where there was lockdown, almost everyone was using Zoom, Netflix, and the like. So you can see from here, let's go back to 2020, okay, early 2020. So Zoom, let me go to Zoom. Um, let me get a clear chance. All right, so let me go back to 2020. Right, so no. Let's check when COVID-19 vaccine was announced. So, all right, so it was around 11 December 2020. Let's look at something. All right, so um, early, early uh, December 19, that was when COVID-19 started uh, coming into the system. That was when we heard of it. So people started moving to Zoom. And because of that, the price of Zoom rose so high that you can see, I mean, uh, it rose up to almost 500 and 905%. Right? There was 905% in the increment in the price. So price rose from $69 per share, 60, $63 per share, up to $520 per share. You can see the increment. So when COVID-19 vaccine was, I think it's, they heard about the COVID-19 vaccine around October here, right? So that was when the price started falling. So price started falling back when the COVID-19. So people started moving away from Zoom because the vaccine is in, people can what meet face to face and then see each other again. So that's what happened, and the price started moving down. And currently, price is at what $82. you can see, right? So me trading CFD, fundamentally, if I have heard that, okay, COVID-19 vaccine has been discovered, then I'm going to what? Short the shares or sell the shares of um Zoom, and then buy it back when it comes through again, right? So basically, that's what this means here. Let's move on. So Zoom stock fell as names benefiting from people staying at home due to the COVID-19 pandemic, right? Under pressure by the vaccine news. So Zoom video closed 17.4% lower. Fellows stay at home, right? Stocks, Amazon and Netflix dropped 5.1%. The same thing too. Netflix was also rising. And then because there was a discovery of Netflix, of the vaccine, it started what? Falling. So, December 2019 here, when COVID came, it started rising. And then October, the same thing. When the vaccine was discovered, see, there was a very big fall, right? There was a very big fall. But now there's what? A big rise again, right? So what happened? So the same thing. It is sorry, I had a call. While we were disturbing, I had a call. Um, all right. So right, so Bank of America had 14%, and JP Morgan Chase jumped and the like. So these are all the so Nasdaq is mainly high tech stocks. Nasdaq lagged and closed in negative territory. However, I hope, however, as hopes for a vaccine prompted traders to turn away from software stocks and other members of stay-at-home trade. So bonds stock price and COVID-19 vaccine. So bonds sort of cause bond prices to drop and yield to rise. So bond yield rose and then what? Bond prices dropped. So purchase of equities of so-called beach stocks. So in class, um, a lecturer did an example of told us that he invested in this kind of assets, bookings, entertainment, and stuff. So during COVID-19, right, since people were not going out, people will not be what going for entertainment, live events, airline, cruise, and those kind of stuff. But when the COVID-19 vaccine was announced, you see that the prices will now be coming back up again because COVID-19 vaccine, the vaccine will let people come back to live events, airlines, and cruise and the like. So the prices will what come back up. So how was COVID-19 different? Right? COVID-19 was different from previous. You see, normally when pandemic happens, you will see that the old or matured firms will be performing. But this particular COVID-19 was more of the other opposite. Young and young and good firms overperform. So young firms that as especially the Netflix, like the tech, this thing was rather what performing, and the old firms was what underperforming. So how an investor could hedge against the pandemic. So the investor can invest in put options. So with these put options, investors can give or can sell the security back or trade it back whenever they see say the price is likely to fall, right? So with put option, you have the option to trade the assets back whenever you were expecting the price is what's likely to fall before even the expected expiration period. Then purchase correlation swap. So you can buy a correlation or pay fixed with profit if realized correlation rises, and correlation rises sharply usually during a crisis. So our lecture also um, showed some example. Let me see whether I can see something like this here. For correlation swap. So we saw that correlation swap wasn't having a clear direction, right? You just see anything on, then a spike, boom, right? That's it. I don't really have much knowledge about it. Checking past questions, I don't see anything in there. That's why I've not really gone to check about it. So there is some group works that we normally do each and every time before we start class. So this is just a review questions. An interest rate be negative, we are not done. We'll just finish everything. So we are now moving on to the financial environment. Types of investment. We have real assets and then financial assets. So real assets are the tangible ones that we can hold, like plants, machinery, buildings. And then the financial assets one are like the stocks, derivatives, and the likes, right? Um, so this course is basically about investment in financial assets. So we have individual securities versus pool of assets. Individual securities can be stocks, bonds, and the like. So one person can buy, and the pool are more or less like different kind of assets that are brought together. So at the following row of financial assets, so patent is a real asset, right? Lease obligation is a financial asset, and then customer goodwill is a real asset, and college education is a real asset. So real assets are more tangible. You can, but financial assets are claims, right? They are just claims. And then a bill of $10 bill is a financial asset. It's just a claim that you have $10 somewhere. Then real estate can be real or financial asset depending on what you are doing. So if you're investing in it, it's a claim. But if you are the one building it, if you are the owner, it becomes a real asset. Commodities also the same thing. So basic investment philosophies. So in forming an investment portfolio, several questions are paramount. In what type of securities should I invest in? That would be what asset allocation. So asset allocation talks about the types of security you should invest in, right? And then within each security class, how do I select which asset to purchase? That becomes the security selection. So the security selection talks about how do I select a particular asset to purchase, or how do I buy a particular asset in a particular security class? That's the security selection. Then how active should I manage my portfolio? Should I be active or a passive investor? So active can be in a form of every day you have to check whether your portfolio is okay. Every day you have to go and check whether they are okay, or whether you have to purchase some other assets to come and then make the correlation good for you or diversification good for you. And a passive one will be like, I've invested, I'm just going off, I'll come back later and then come and check. So summarizing the basics first. So for asset allocation, when you are active, you are using market timing, and then passive, you are maintaining predetermined allocation. While security selection can be stock picking a particular stock, and then passive can be trying to track a well-known market index. right? It's like the Nasdaq and the likes. So some ethics in investment. So as accounting students, we know about our ethics. So that's this same thing also applies in finance too. So financial markets are vitally important to a well-functioning economy. Trust in information and faith in fairness are essential. So these firms are like firms that were caught in fraudulent activities in Ghana. Diamond Microfinance, DKM, US Tilapia was also caught in fraudulent activities, and then Hiram also was also caught in fraudulent activities. You can get time and then read about them. Then Ben and Madoff also, the US also caught in fraudulent activities. So ethics in investment. So code of ethics for financial professionals and strict regulations attempt to create such an environment where financial markets can efficiently fulfill their economic functions. So for example, the 5 fundamentals ethical principles set out in the ACCA rulebook are integrity. Integrity basically means being straightforward, honest in all professional business relationships. Objectivity, it also talks about not allowing bias, conflict of interest, or undue influence of others to override professional or business judgment. Then, professional competence and due care. Also, to maintain professional knowledge and skills, be up to date, right, at level of requirement to ensure that client or employer receive competent professional services based on current developments in practice, legislation, techniques, and act diligently and in accordance with applicable technical professional standards. So basically, you have to up to date whatever is happening in finance. Confidentiality, also respect information. So whenever maybe you are working in a particular firm, you don't have to disclose information outside, right? If you have information about someone's investment, you don't have to bring it out, right? That's the confidential professional behavior and due care to comply with relevant laws and regulations and avoid any action that discredits their profession. So if you write any of the professional exams and you get certificate and you are being awarded a profession and you are found to be what uh, not being confident, like not practicing the concept of confidentiality, you are likely to be what your certificate is likely to what withdrawn. So these are some of the professional designations. The Ghana Security Industry Course, the Global Medal for Financial Risk Professional, the gold medal, so CFA chapter, so gold medal for investment practitioner, and then the ERP, energy risk professional, and then also the certified financial planner, and then the ACC. So this is where, right? So let me check something. All right, so we end at ethics in investment. So this is where we end our session for today. In case you have any question or you didn't understand it, you can drop it in the comment section where I'll be there to give you more explanation. Thank you very much. And then make sure you like this video and also share it to your friends. Have a good evening. Bye. See you some other time.